On one side, you've got falling profits and serious market headwinds. On the other, the Oracle of Omaha himself is giving it a huge vote of confidence with his own cash. And here's the kicker. Right now, you can get in at an even better price than he did. So, which is it? Is Pool Corp a diamond in the rough that the market has unfairly punished? Or is it a falling knife you just don't want to get caught trying to catch? That's exactly what we're here to figure out. Through a head-to-head debate, we're going to lay all the arguments, the data, the risks, and the opportunities out on the table to help you make a precise investment decision. So, let's get right to it. Please welcome our two guests.
Ladies and gentlemen, I'm here to make the case for why Pool Corporation, ticker symbol POOL, deserves a place in your portfolio today. Let me start by introducing this remarkable company. Pool Corporation is the world's largest wholesale distributor of swimming pool supplies, equipment, and related products. Think of them as the essential middleman between manufacturers and the thousands of pool builders, retailers, and service companies across North America, Europe, and Australia. With 448 sales centers globally, that's more than triple the size of their nearest competitor. They've built an unmatched distribution fortress. But I want you to think of them differently. Pool Corp is the essential utility for the American backyard. Just like you pay your electric bill, the 11 million pool owners in the U.S. have to pay for the chemicals, parts, and services that Pool Corp provides. This isn't a luxury, it's a non-negotiable cost of ownership. Here's what makes their business model so attractive. Pool Corporation generates $5.3 billion in annual revenue, and here's the beautiful part. About 60% of that comes from maintenance products like chemicals, filters, and repair parts. This isn't discretionary spending, folks. When you own a pool, you must maintain it. Chemicals don't care about recessions. They're needed year-round. In fact, even during 2024's challenging market, their chemical sales actually grew 2%, while overall sales dipped. Now, let me tell you why this is a compelling buy. First, Pool Corporation enjoys what I call a defensive moat. Their massive scale gives them incredible buying power with suppliers like Pentair and Hayward, allowing them to negotiate better prices than smaller competitors. Their 448 strategically located sales centers ensure they can deliver products faster and more efficiently than anyone else in the industry. Second, the financial quality is exceptional. They generate over $650 million in operating cash flow. That's 152% of their net income, showing incredible cash conversion. Their return on equity sits at an impressive 31%, placing them in the top tier of industrial distributors. Third, management treats shareholders like partners. They've raised dividends for 20 consecutive years and returned $483 million to shareholders through dividends and buybacks just last year. But here's my knockout argument. Even Warren Buffett's Berkshire Hathaway increased their stake by 144% in 2025, investing around $466 million. When the Oracle of Omaha backs a company with recurring revenue streams and a dominant market position, smart investors pay attention. The stock trades at reasonable valuations considering its quality, and with 11 million pools in the U.S., requiring ongoing maintenance, Pool Corporation has built a cash-generating machine that compounds wealth over time. Thank you.
Ladies and gentlemen, while my opponent presents a compelling narrative about Pool Corporation's past success and distribution network, I must expose the harsh reality hiding behind these glossy statistics. First, let's address the elephant in the room, those strong financials. Yes, Pool Corp generated $5.3 billion in revenue, but what my opponent failed to mention is that this represents a 4% decline from 2023. More concerning, their net income plummeted 17% to $434 million, and earnings per share dropped 15% to $11.3. These aren't signs of strength, they're red flags waving in broad daylight. The construction collapse is devastating their growth engine. New pool construction has fallen approximately 15 to 20% in 2024. When your opponent talks about recurring maintenance revenue, they're whistling past the graveyard. Maintenance only grows when new pools are built, and that engine is stalled. Now about Warren Buffett's investment, let's get the facts straight. Berkshire initially bought 404,000 shares worth $152 million in Q3 2024, then increased to 1.46 million shares worth $466 million. But here's what my opponent won't tell you. Buffett is currently sitting on an estimated $55.75 million loss, representing an 11.06% decline on his Pool Corp holdings. Even the Oracle of Omaha isn't immune to value traps. The valuation story is alarming. Pool Corp trades at a P/E ratio of 28.6, nearly double the industrial average. Multiple independent analyses show the stock is overvalued by 19 to 30%, with intrinsic value estimates around $248 per share compared to today's $306 price. This isn't a reasonable valuation, it's a recipe for disappointment. My opponent wants you to focus on the past, but investors must look forward. Pool Corporation faces a perfect storm of declining construction and overvaluation that makes it a clear avoid at current prices. Thank you.
Ladies and gentlemen, thanks for that spirited rebuttal from my opponent. But let's cut through the noise and focus on why Pool Corporation remains a smart buy, not just based on past wins, but on real forward-looking strengths. First off, yes, 2024 saw a 4% revenue dip to $5.3 billion and a 17% net income drop to $434 million. But this is classic post-COVID normalization. After massive 2021-2022 booms, the key? Their core maintenance business, that 60% recurring revenue from chemicals and parts, actually held strong, with chemical sales up 1% despite the slowdown. Maintenance doesn't stall without new pools. It's driven by the existing 11 million U.S. pools that need upkeep every year, rain or shine. On new construction, sure, it dipped 15 to 20% last year, but that's cyclical, not structural. Analysts see a rebound in 2026 as interest rates ease and housing picks up. Now, about Buffett. My opponent points to an 11% paper loss as if it's a sign of failure. Ladies and gentlemen, that is a sign of opportunity. What is Buffett's most famous saying? Be fearful when others are greedy, and be greedy when others are fearful. The market is fearful right now. Berkshire isn't just holding, they doubled down. They are showing you in real time what being greedy looks like. They see the long game pool's 16% return on invested capital and 30% return on equity, which crush industry averages. Folks, this isn't a value trap. It's a high-quality compounder at a fair price. Thank you.
Ladies and gentlemen, my opponent is trying to paint a rosy picture of recovery. But let's look at the cold, hard facts showing why Pool Corporation is still a clear avoid for your portfolio. First, that post-COVID normalization excuse doesn't hold water. Pool Corp has now suffered 9 straight quarters of revenue declines, with Q1 2025 sales dropping another 4% to $1.1 billion. Their so-called strong maintenance segment? Chemical sales might be up a measly 2%, but overall maintenance revenue is flat at best, tied to an aging pool base where owners are cutting back on spending amid high inflation. On Buffett, sure, Berkshire sees long-term potential, but their 16% ROIC is down from 25% peaks, and that 30% ROE comes with massive debt. Buffett's position is underwater by over 11%, and history shows even he sells losers. Remember his quick exit from similar cyclicals. Folks, these trends point to ongoing weakness, not a quick turnaround. With persistent headwinds like high interest rates and a sluggish housing market, Pool Corp's future looks murky at best. Don't risk your money on hopes of a rebound. The data screams caution. Thank you.
Ladies and gentlemen, let's bring this back to what matters for a long-term investor. My opponent wants you to dwell on yesterday's storm and short-term headwinds and quarterly noise. I'm asking you to focus on the clear skies ahead. Yes, sales are down as we normalize from a historic boom, but don't mistake a cyclical dip for a structural problem. The heart of this company, its maintenance business, which services 11 million pools, remains incredibly resilient, with sales in that segment growing 1% in the first quarter of 2025. That's the bedrock of this investment. And let's be clear about the debt my opponent mentioned. While total debt was $1.34 billion as of March 2025, the company actively reduced its long-term debt by over 11% in 2024, showing prudent financial management. Warren Buffett isn't day trading, he's investing in a durable, market-leading business with a massive competitive moat. So, the choice is simple. You can bet against a proven industry leader during a temporary downturn, or you can invest in a high-quality cash machine that has consistently rewarded shareholders for decades. I know where I'm placing my bet. Thank you.
Ladies and gentlemen, my opponent wants you to ignore the warning signs and bet on hope, but smart investors follow the data, not the dreams. Here's the reality. Pool Corp isn't having a temporary downturn. They've posted 9 straight quarters of declining sales. That 1% maintenance growth? It's barely keeping up with inflation while their core construction business collapses. Yes, they reduced some debt, but they're still carrying $1.34 billion in total debt while their cash flow shrinks. And that cash machine? It's producing 22% less cash than last year. My opponent loves to talk about their competitive moat. A moat is great, but it's useless if the castle inside is crumbling. And right now, the castle of new pool construction is shrinking, and the maintenance kingdom is barely growing faster than inflation. That moat is protecting a shrinking asset. The stock trades at 28 times earnings, double the industry average for a company with shrinking margins and declining profits. This isn't value investing, it's value destruction. Don't fall for the clear skies ahead story when the storm clouds are right overhead. Pool Corporation at current prices is a clear avoid. Your portfolio deserves better than a sinking ship with an expensive ticket. Thank you.
All right, over to you, the judges. What do you all think? I'm looking forward to seeing your votes and thoughts in the comments section. We love hearing what you have to say, and I believe every perspective brings something valuable to the table. Also, I've done my best to fact-check the information you've just heard, and you can find the relevant links in the description box below. Before you go, don't forget to hit that like button and subscribe. Your support means the world to us. We'll see you next time. Bye-bye.